And now back to BNN's top line. Markets are in Dow 20,000 watch mode. My next guest says that Donald Trump is getting too much of the credit for the run-up as it started ahead of his surprise win on November the 8th. For more, we're joined by Barometer Capital Management's Diana Avigdor. Diana, good to be with you today. Thanks very much for joining. Good to see you. And yes, I mean, I suppose we could say we were in a big bull market from the lows of the financial crisis. But I think, though, that the market's really rallied since he won. I mean, you can't deny that.
It certainly triggered some animal spirits, as people call it. But if I was to run, we talked about this, cyclical and non-cyclical. I remember back in mid-year we were barbelling our portfolios, and half it was cyclical and half defensive. And as we rotated out of defensive into cyclicals, as the market was telling us that that's where the money was flowing. If you run charts, and I have one back in my office, I wish I sent it to you, you would see, if you ran the low vol versus the cyclical, you would see that the movement has started before the elections. And there were lots of conversations about monetary policy coming to its ability to, the end of its ability to continue to trigger any kind of growth, and monetary authorities were calling on governments to start looking at the infrastructure spending and fiscal investment. And then came Trump. But before the elections, this already was set in motion, and certainly a friendlier government, a more pro-corporate government, less regulation, and an eye towards growth certainly continued the rally.
Dana, you know, as you and I have talked over the past, years, but certainly over the past year, and your barbell approach, defensives and also cyclicals, what are you doing now in terms of how much have you shifted away from owning defensive positions, because it seems that there is the real potential for growth?
Right. We have a very disciplined strategy of rotation as things are stalling, and stocks don't have to move down for us to rotate out of them. We also have stop losses, very disciplined stop losses, and very disciplined strategy of moving out of things, not just moving into things. But as they were underperforming and other things were moving up, it sort of pushes us out. And for now, right now, and we kept increasing our financial exposure, we kept increasing our energy exposure. I mean, there were times when we were at zero. So we're industrials, financials, technology, and industrials, and some consumer discretionary. We're seeing some money moving back into some of the retail stocks and so forth. So at some point, you know, mid-year, maybe end of the summer, September, by then we would have been fully rotated out of bond proxies. That doesn't mean that we're not looking for yield. We do have yield products. We do have the Canadian banks. They offer very nice yield. And we barbelled that, not barbelled, but maybe diversified our financial exposure between Canada and the U.S., as the Canadian banks do offer a better dividend yield.
Dana, where do you want to get yield from in this market? And of course, you just said the Canadian banks, but I think it's really hard for some of our viewers who have been depending on yield from dividend stocks, given the fact that the interest rate environment has been so low, to really understand what they might need to do right now and how much risk they might be in if they own the utilities, if they own the REITs. What do you say to those viewers who would have those concerns or really wondering what to do?
That's a very, very good question. And actually, this is exactly what zero rates or low rates have punished. They punished the savers and those that needed to create income out of their savings. So there's the banks. You might have to go into maybe some corporate bonds, maybe some good high yields. At some point, there's some rotation, certainly. You have to give it some time for some rotation to ensue and for opportunities to come up. You know, high yield bonds, corporates do offer equity-like type of returns with a fixed coupon and a fixed maturity rate and a good growth environment, the good company, those tend to be better. I wouldn't be right now in government bonds, as the interest rate environment is not friendly to them. You have the banks. You might want to take down maybe lower yielding stocks with lower dividends and hope for some more capital gain type of investment. But at some point, as rates normalize, it's a nice thing to think about, being able to be invested in the right place for your risk tolerance. a lot of people have moved into some utility-like or equity-like investments because that's what offered the yield. Really, people who don't want risk have to be in fixed income investments, and that model sort of broke down.
Well,
so.
it broke down, but two questions. First of all, do you mean by that it's nice to think that you could get maybe 4% somewhere? Do you mean just be a little bit patient and actually go maybe sell your fixed income products right now to a degree and go back into the market once you think that maybe we've started to see the move and the steadiness of the fixed income market, and go back in and expect to get par on maturity with a nicer yield than you've been getting? Is that what you're saying?
Yeah, and I think that there is a larger cap, stick with larger cap, liquid, good, solid blue chip type of companies, and then eventually you can purchase a shorter duration corporate bond that offers a coupon and a fixed maturity at the end that is shorter and has less exposure or less sensitivity to interest rate increases. Although in Canada, Catherine, we're in a different place in Canada than the folks in the U.S. in terms of interest rates. I think that we still have a ways to go for that.
Should you be selling your utilities and REITs right now?
It depends. It depends on the makeup of your portfolio. There are some very good yield investments that are solid and can stay. Should you be overweight certain bond proxies? No. But there are solid investments that you can balance out in your portfolio. And certainly the world has been underweight the banks. And we talked about a couple of interviews ago how they were such a short favorite. I do think that's a good investment. That's why we're in. There are headwinds, and people are talking about negative reasons why the banks are expensive, why they're overvalued.
Right.
But at the end of the day, that's not at an extreme yet. Governments are cautious, and the yield is friendly.
Last question, Diana. With respect to 20,000 on the Dow, does it mean anything to you?
It makes me look at it with a smile. But we're human, and this is a people's business, and 20,000 is such a nice round number. It means not much from an investment perspective, really. Nobody's going to buy the market because it's hit 20,001, but it highlights how far and how high it has become. And it's interesting that it's the Dow that is the folk. I know I said large cap, but really in the U.S., some of the markets that have really benefited was the mid cap and the small cap because of their low foreign exchange translation exposure. But people like to buy the market. It just tells you that people need to get their placeholder in place. In other words, they need to invest in something that's scalable, investable, and liquid, and maybe then move down the chain.
Okay, we'll leave it there. Dana, good to see you. Thanks so much.
Thank you.
Happy holidays.
Happy holidays.